The clock is ticking down toward another U.S. trade deadline at the end of this month, and with some signs that our economy may already be slowing, what could be at stake for Canada? Joining us now to discuss is Derek Burlton, VP and Deputy Chief Economist with TD. Derek, great to see you as always.
Hi, Greg. Great to be here.
So we have no shortage of deadlines. I mean, we've been kicking the can down the road. We're not sure exactly what's going to happen in 2 weeks, but let's set the stage. Regardless of that outcome, where are we right now in the Canadian economy? What's the data looking like?
Data's been pretty good for the most part. Now, again, it's relative to where we thought we would be. I would say you go back to the June jobs report, reassuring. We saw a nice little mini explosion of hiring in the month of June. After 4 very weak months, the unemployment rate dipped a bit. So I think that made forecasters feeling a little less gloomy, a little less down about the economy. Look at other areas like housing. We've now had 3 months in a row of rising home sales in Canada. That market appears to be gaining a little bit of traction. We'll get data later this week on retail consumers. My guess is they'll probably have held up quite well. Some of that tariff front running is still kicking in. And on inflation, some may have been a bit surprised that the inflation numbers were as sturdy as they were when you look at the Bank of Canada's core measures, which they tend to focus on, still running about 3%. That's on the high side. But the fact is that the economy were really weakening to any great degree. You wouldn't be companies trying to push through price increases. So you can flip that around and take it as a sign that the economy is holding up better than some may have thought.
Holding up better than some may have thought. As you said, we do have yet another trade deadline. We don't know exactly what the outcome will be. If we could run some scenarios, how bad could things get if we end up in a worst case kind of scenario, a 35% tariff on the non-USMCA goods? We already got those steel and aluminum and other tariffs on different sectors. How damaging could it be?
Well, I think we are getting some clarity in that every announcement we get on new tariffs, the U.S. administration is exempting USMCA compliant exports. About 2/3 of Canadian exports comply with USMCA, meaning they're exempt. Outside of, as you mentioned, some of the sectoral tariffs in copper and steel. I think when you kind of look at it, if they were to go ahead with that 35%, it would drive up Canada's effective tariff rate from the U.S. to about 13 to 15% from around 10% currently. So, obviously not constructive, but, not a dramatic sea change from what the economy has been facing. I do wonder on the 232, a 50% tariff on copper, aluminum, in my view, is just not sustainable from the United States. They're too reliant on Canadian shipments. So I do see some of this being a negotiating tactic. As we know, both sides are really intensifying discussions. I think, so we'll see how discussions go. Little bits and pieces makes me think that maybe a deal may be forthcoming before August 1st. Carney's been out there trying to manage expectations that there will be some level of tariff, some level of quota on many Canadian goods. We'll see where that ends up. Talking about lumber, that they're really pushing towards some sort of understanding on lumber trade, and on some of the steel announcements last week, the U.S. was exempted. So I wouldn't be surprised, Greg, if this week we do hear some evidence of a deal. The last thing I just say is that, in terms of what happens with other countries matters to Canada, because markets, if we get to a point August 1st and we hear big tariffs on Europe and they go ahead and look like a trade war, Canada would be affected through financial channels. So we can't just be focused on the effective rate on Canada, but, more directly on what's going on around us.
All right, so a few things going on there that could impact our economy, even if we do end up with a deal and a higher, marginally higher effective tariff rate. What can the Prime Minister do? What can the Carney government do to try to mitigate the impacts of this economy?
Well, it'd be interesting. The premiers and Carney are meeting today, and we'll maybe get some headlines from that. But, I think their strategy, they're looking ahead to their upcoming budget. It's going to be one very much on pivoting Canada's economy, build, baby, build when it comes to Canada, the port infrastructure, diversifying trade, both domestically, internationally. And I do think something will come from it. I'm under no illusion this pivot's going to be easy. They're facing budget constraints. But all that to say that I do like the direction. There are opportunities I think that will make Canada more resilient. but it will take time, and they'll have a lot of obstacles, including regulatory, to get around.
It takes time for those kind of measures to kick in. We've spoken a couple times this year about the economy. You say it's more resilient than we thought. I keep hearing the R word, the chance of a recession. Is there still a chance? Is there a forecast that we slip into recession?
Yeah, again, splitting hairs a little bit. Usually it's the definition, 2 straight quarters of contraction. I do think the second quarter is a slam dunk. We'll see a contraction. Part of that is just some of the swing and trade from front running and first quarter washing through the data. It's going to drive down GDP in the second quarter. I think for me, the big question, do we see another contraction in the third quarter? I think so much of that will depend on, do we get a framework deal? I think even if we do, the uncertainty over Canada is going to loom relatively large, because you're always worried that the administration is going to shift tact at any time and to start threatening tariffs. But I do think it would help avoid that second consecutive negative quarter, and I do see a little bit better growth at the end of the year. So I am hopeful that we will see some kind of a high-level framework deal, and that will avoid recession. And if not, then I do think we'll have a hopefully fairly short-lived technical recession over Q2, Q3 of this year.
You talk about all that uncertainty, Derek. It certainly does seem to be weighing on the Bank of Canada in terms of them staying on the sidelines on rate policy. Got another meeting coming up next week on the 30th. Where do you see rates headed in this country?
Yeah, I think the next week, pretty much slam dunk, they won't move. We had the Business Outlook survey this morning, which they do tend to put a lot of emphasis on. Nothing there, I think, will change rates one way or another. I think the data has just been resilient, and I think that's a good thing. But if you're looking for lower short rates, it doesn't help build the case. September, I think, is still an open question. If we do get a couple of weaker jobs reports, Q2 GDP comes in contraction, I do still think the risks are tilted towards a move in September and maybe even follow up in October, but it'll depend a lot on the tone of the data, and we do need core inflation to begin to ease off a bit in the next couple of reports for 1 or 2 cuts to come down the pipe.